If you believe YouTube, China's economy will collapse in 47 days, or 29 days, wait, 25 days, or it's already crashed. It's important because China is the world's second largest economy at over $18 trillion. US consumers buy more than 450 billion in Chinese products, and the Chinese buy 181 billion in US products every year. Not only would a China economic crisis mean a recession in the United States, but also plunging stock markets around the world. But Chicken Little, is the sky really falling? YouTubers love to shock you and feed you that daily dose of outrage, but do they really know what's going on? In fact, researching for this video, I couldn't find a single one that gave both points of view or actually told you what a China economic collapse would mean for you. In this video, I'll flash back to my days working as an actual economist to explain the economic crisis in China, how it got so bad, and why things aren't quite as bad as YouTubers like to make you believe. I'll then reveal what this means for your money and the US stock market. We're getting started, but before we do, I've got to send that special shout out to all you out there in the nation. Thank you for spending a part of your day to be here. If you're not part of that community yet, just click that little red subscribe button. It's free and you'll never miss an episode. Now I'm going to walk you through how it got so bad that we're talking about a China collapse, but big shocker, the old stock analyst and economist isn't the best at telling stories. Other YouTubers out there like Graham Stephan and Andrei Zik are much better at that, and they do bring up some good points, so I'm going to link to their videos in the description below. Check those out for the background, and I'm going to cover the other side of the story in this video, the one you're not hearing anywhere else. Like all countries, the Chinese government borrowed its way out of the 2008 financial crisis with massive stimulus packages that ballooned the total debt from 140% of the economy to over 250% by 2018. Here you see that total debt as a percentage of GDP, or the economy, for China as well as Japan, the US, and Europe before and after the financial crisis. It's now caught up with the US and Europe, though it's still well under the 400% plus in Japan. Of course, the argument is that a country can't go into debt forever, that the bill always comes due. And while higher debt in Japan has slowed its economy over the last 20 years, it's been above 300% debt to GDP for decades and hasn't really suffered a crash. But not all of China's debt is owed by the government. In fact, most of it is private company debt, and that's where the real problem is coming from. This chart shows data from the Bank of International Settlements, showing the percentage of debt to GDP from three sources: what's owed by the government, households, and businesses. And here we see China's government actually only owes 67% of GDP in debt. That's less than half the 129% debt to GDP we see here owed by the US government. Household debt in China is also lower at 61% the size of the economy, compared to here in the US with 80% debt to GDP owed by consumers. It's really here in this non-financial corporations debt that we see the problem in China. This has surged to 160% the size of the economy, roughly $29 trillion owed by businesses, versus what we see in the United States here with 85% debt to GDP for corporates, or about $24 trillion. Now, how this got so bad is over the last decade, real estate developers have built up insane leverage to finance their projects. These companies were providing financing to their buyers to pre-sell their apartments before they were built. They would then use those financed assets to get another loan from the bank to buy more property, pre-sell those apartments, and the cycle just kept repeating into hundreds of billions in debt. And it's worked because real estate has been a great investment in China. Annual price appreciation has been between 5 to 10% over more than a decade, with some years growing 15% and more. And besides just that return, home ownership in China is a cultural phenomenon. Because the stock market and other markets aren't quite as developed, home ownership has always dominated as a way to build that generational wealth. As a result, 90% of the households in China own their own home, with many owning multiple investment properties. Now, a lot of YouTubers have been comparing the use of leverage by developers to a Ponzi scheme, mostly because it's just fashionable to call everything a Ponzi scheme these days to scare viewers. But that's not what's happening here. A Ponzi scheme is when new investor money is used to pay out returns to previous investors, to make those returns seem legit, but there's no real investment going on. It's unsustainable because you always need that new investor money. There are no real returns because there's no real investments. Instead, here we do have legitimate real estate projects financed through mortgages and buyers. And while the projects have been delayed and some buyers are protesting, something that I'll detail later, this isn't some kind of scam that is now unraveling. Now, YouTubers are saying a crash is imminent because the developers are facing huge debt maturities this year and forcing a solution. Developers owe $116 billion in loans due this year, $133 billion next year, and $117 billion due in 2024. And given all this, a crash would be a ginormous problem. Real estate is a big part of the economy in China. Because of that cultural history, real estate is 29% of the total economy, and 70% of household wealth is stored in property. That's about twice as much as the 15% of the US economy driven by the real estate market. Now, I'll come back to China's debt and why it's not as bad as others want you to believe, but let's look at how bad this could get and what it means for you. I'll reveal exactly what this means for you as an investor next, but first, I want to personally invite you to get the Weekly Bowtie, our free weekly newsletter with all the stock market news, strategies, and trends you need to know. Each week before the market opens, I'll show you what I'm watching and the stocks that could highlight the week. It's all totally free, just something I like to do for all you out there in the community, so look for that sign up link below. As the world's second largest economy at $18 trillion GDP, China is inevitably linked to every other country. Chinese consumers buy more than $181 billion from the US companies each year, and US consumers buy nearly $500 billion from Chinese businesses. If China were to bust, the US could see its economy collapse as well. More importantly, China buys more than half the global supply of a lot of commodities. This is a great chart by Visual Capitalist showing exactly how much of 12 metals, energy, and agricultural products go to China. The country accounts for half the global copper demand and 59% for cement. For agricultural products like cotton, corn, and pork, China consumes as much as 47% of the worldwide production. The China crisis is a big reason for the massive sell-off in commodity prices this year. The price of copper has collapsed 27% since late last year, and corn is down 15%. If China were to crash and stop buying those commodities, we could see a mass bankruptcy of miners. Agriculture would collapse with a farm crisis to rival the 80s, and it could be the start of a global depression. Look, I'm the last person to be defending the Chinese government. I'm a patriot to my bones, and the CCP is a failed system just waiting to happen. But I'm also not going to sit here and try to shock you or lie to you just for the sake of views. There is another side of this story here that you're not getting from other YouTubers. A side that shows that the economic collapse isn't quite as terrible or close at hand as you're being led to believe. First, understand that economic measures in China aren't quite like what we think of them here in the United States. Here we look at GDP growth and other economic data as real measures of the economy, how much it grew or how much it didn't. Because China's economy is controlled by the government though, and because it has a massive ability to issue debt or use its reserves, those economic measures are less of what happened and more what the government planned. And I'll show you next how the Chinese government could boost the economy by trillions of dollars if it wanted to avoid a real crisis. The only question is, how far is it willing to go and how much pain is it willing to take to bring debt down? Now, this part of the conversation is getting into the weeds a little bit on understanding how the economy really works, and that's something most YouTubers just don't understand. As for housing, China's housing crisis is bad, but as with everything here, you have to put the numbers into perspective. Saying tens of thousands of homebuyers are refusing to pay their mortgages sounds like a cataclysmic scenario until you consider 9 in 10 of the 494 million households in China own their homes. That's over 440 million homeowners, so even if 500,000 mortgage payers went on strike, it would still only be about 0.1% or about 1 out of every 1,000 mortgages. And that cultural goal of owning a home, the fact that 70% of wealth is in real estate, isn't going to change on one crisis. Housing has always been the way the Chinese save their money, and instead of changing that, a drop in prices is more likely to mean buyers come into the market and ultimately support a floor on those prices. With government debt in China only 67% of GDP, less than half of where it is in the US and other developed countries, the government has a lot of room to borrow and stimulate the economy. Now, does that corporate side of national debt at 160% of GDP need to come down? Of course it does, and we're seeing that happen right now. But the Chicken Littles have been screaming about high debt to GDP of countries for decades now, and it's yet to cause the kind of depression they're always warning of. In fact, part of the reason for China's government debt is a good problem to have, and it's helped it build up over $3 trillion in reserves. Because US consumers buy $480 billion in Chinese products and only sell about $180 billion in products to China a year, the country's businesses have hundreds of billions in net dollar purchases each and every year. This would normally drive up the value of the Chinese currency, the renminbi, but the government buys these dollars from businesses and then uses them to buy US Treasury debt instead of converting those dollars back into renminbi. That keeps the currency weak and Chinese products cheaper to buy in the global market. But it's also meant that the Chinese government has built up a massive investment in US Treasury debt to the tune of $3.1 trillion. It's leveled off here over the last 6 years because of the government spending on stimulus programs and investment in its Belt and Road Initiative overseas, but it's still almost 17% the size of the economy saved away. Now, of course, there would be some side effects of selling a big portion of that treasury debt investment, like it would strengthen the renminbi and cause exports to be more expensive, but it still represents hundreds of billions of dollars the government could use to stimulate the economy. In fact, with the value of the dollar at a 10-year high against other currencies, now is the perfect time to sell some of those reserves. For example, the total funding gap for lost land sales and the economic impact to local governments in China is estimated to be around $895 billion. That's about 5% the size of the $18 trillion economy, but still just a fraction of those reserves. Easily manageable, and in fact, we have precedents for it just over the last 2 decades. This chart by McKinsey & Company shows the percentage of GDP spent on stimulus for 9 countries. The pandemic stimulus is in blue here, and the stimulus spent during the 2008 financial crisis in black. You can see the US government, as a percentage of GDP, spent 4.9% to get the economy back on track after the housing bubble burst. China's government has already started on those stimulus programs, cutting interest rates even as the rest of the world raises rates. So what we're going to see over this year and next, China is supporting its economy with cuts, while here at home, the Fed is expected to increase borrowing costs from 0 to 4%. The government is also issuing $29 billion in special loans for those stalled housing projects to make sure they get built and delivered to buyers. Now that probably won't be enough, but Bloomberg does estimate that it would take about 1.3% of GDP, or about $230 billion, to complete all the underfunded projects. In June, China also announced a new strategy of 33 measures, including tax cuts and rebates up to $396 billion to 6 industries, including manufacturing and small business, along with another $148 billion in new loan bank financing for those delayed housing projects. But what does this all mean for you as an investor? First is that China's economy is probably not going to collapse like so many have been warning. Slower growth, yes, but not the kind of sensational crash you hear about. That means this is more of a distraction than anything. A story to shock you and distract you from the fact that right here in the United States, the Fed is raising rates to slow down the economy and causing that roller coaster in stocks. China will let some developers bankrupt and will bail out others, easing that stimulus into the economy to avoid a crash. But in truth, in 2 years, we're probably going to look back and wonder where the big fireworks were. Click on the video to the right to see how many shares of stock you need to buy to make $1,000 a month, how much to invest in popular stocks like Microsoft, AT&T, and Pfizer for monthly cash flow. Don't forget to join the Let's Talk Money community by tapping that subscribe button and clicking the bell notification.